Well, any data point that suggests that there's too much strength in the economy or not enough strength, if it's not Goldilocks, I'm sure the market will react in the short term. But we've had a lot of fear that inflation is really kind of stalled here now and won't go lower. So we could also have surprises, positive surprises that send the market higher.
In your notes, by the way, you say rate cuts, they're not canceled, they're just delayed. I want to move to the equity market. Apple, the big story today. Part of the Magnificent Seven stocks. I want to ask you, is there still concern about over-concentration in these big cap tech stocks, or have their earnings proven that these are safe places to put money and that this narrative is still intact?
Well, I think the way we look at it is in our base case, where we see the inflation picture improving and rates start to be cut, we would expect the rally to broaden out and could even extend to small caps, say in the United States and Europe. But we've also had this real focus on quality stocks that have very strong balance sheets, stocks that have pricing power, are improving their dividends, improving their buybacks, have recurring revenues. And as we've seen, this week and I think last week, a lot of these large tech stocks still fit that bucket. And so we think they're still attractive, particularly in the longer term.
I want to go back to your comment about small caps. If you ever watch Worldwide Exchange, I often give the guest a hard time about small caps because everybody keeps calling for a rally in small caps. I'm looking right now. They're just flat year over year. So just very quickly, when it comes to small caps, what are going to be the catalysts for these small caps to move higher? Because when we had 6-cut expectations, they still were laggards. And then we went down to 3-cut expectations, they were laggards. Now we're on possibly, I know you're not in this camp, but possibly a no-cut expectation. And again, they're laggards.
Well, yeah, I think that you're absolutely right that it is tied to the outlook for how well these companies will be able to refinance at better prices in the future. So that's a catalyst. Again, we see 2 rate cuts in the back half of the year still, given this kind of more dovish outlook still from the Fed. And just pointing out that in that case, that would be the kind of the extreme end of what could rally. But we would also expect, that would work. But even if it's not as positive for small caps, a more benign environment should help the overall rally kind of spread out even in the S&P 500.
To your point, though, materials and financials have outperformed over the last month or so, or last couple months, actually. So we have seen that broadening. I want to talk to you about fixed income, specifically U.S. bonds and also global bonds. Have bonds, the yields there, have they become so attractive that it's actually pulling from the equity market? We know that money markets certainly are when you get about 5% in a money market.
Yeah, well, we've seen our clients globally looking at, those attractive rates at the shorter end. And absolutely, they've been moving there. And it's very different than a few years ago when you were looking at bonds and just looking for capital appreciation, but you had no yield. And now you have yield and the potential for capital appreciation. I think for us, we see spreads very tight kind of around the world. And so we would focus on quality, probably, especially like investment grade, 5 to 10 year maturity. So you're somewhat cushioned if we have something outside of our base case and rates stay even higher for longer.